In present days, lot of people face problem with unavailability of books due to high cost, inadequate delivery, and limited options available in their locality. So mypustak.com is a social innovation to bridge the gap between those who have books and those who have not by providing free books at their doorstep.
We are committed to help.
जो आपके बालों को मजबूत बना सकते हैं.
We're going to style this top in 6 absolutely different ways.
மினி ஷாப்பிங் பண்ணேன். நான் எப்பவுமே நிறைய வாங்குவேன். ഈ ഫേഷ്യൽക്ക് എല്ലക്കല്ല് എటువంటి ബ്യൂട്ടി പാർലേഴ്സ്ക്ക് మీకు అవసరం లేదు.
കുളിപ്പിക്കുന്നതിന് മുമ്പ് നമ്മുടെ ബോഡി ഒന്ന് മസാജ് ചെയ്യുന്നത് എന്തുകൊണ്ടും നല്ലതായിരിക്കും.
ಇಷ್ಟ ಆಗಿದ್ರೆ ನೀವು ಕೂಡ ಟ್ರೈ ಮಾಡಿ ನೋಡಿ.
वन विभागाच्या अखत्यारात आहेत हे दर्शवतात.
এই হার্ড টাইমটা যখন আমাদের লাইফ থেকে শেষ হবে ফাইনালি.
जो आपके बालों को मजबूत बना सकते हैं.
We're going to style this top in 6 absolutely different ways.
மினி ஷாப்பிங் பண்ணேன். நான் எப்பவுமே நிறைய வாங்குவேன். ഈ ഫേഷ്യൽക്ക് എല്ലക്കല്ല് എటువంటి ബ്യൂട്ടി പാർലേഴ്സ്ക്ക് మీకు అవసరం లేదు.
കുളിപ്പിക്കുന്നതിന് മുമ്പ് നമ്മുടെ ബോഡി ഒന്ന് മസാജ് ചെയ്യുന്നത് എന്തുകൊണ്ടും നല്ലതായിരിക്കും.
ಇಷ್ಟ ಆಗಿದ್ರೆ ನೀವು ಕೂಡ ಟ್ರೈ ಮಾಡಿ ನೋಡಿ.
वन विभागाच्या अखत्यारात आहेत हे दर्शवतात.
এই হার্ড টাইমটা যখন আমাদের লাইফ থেকে শেষ হবে ফাইনালি.
So that you can read and fulfill all your dreams, whatever you are thinking in your life. You want to be a doctor, you want to be an engineer, you want to be a lawyer. You can become by just reading the books. Books are very essential.
ಇವ್ರ ಹೆಸರು ವಿಕಾಸ್ ರಂಜನ್ ಅಂತ mypustak.com ಇಂದ ಬಂದಿದ್ದಾರೆ. ಸೊ ನಿಮಗೆ ಬುಕ್ಸ್ ಕೊಡ್ತಾರೆ. ಈ ಬುಕ್ಸ್ ಬಂದು ನಿಮಗೆ ತುಂಬ ಹೆಲ್ಪ್ ಆಗುತ್ತೆ. ನಿಮ್ಮ ಆಂಬಿಷನ್ ಏನಿದೆಯೋ ಎಲ್ಲ ಡ್ರೀಮ್ಸ್ ಫುಲ್ಫಿಲ್ ಮಾಡೋಕ್ಕೆ.
Hey guys, when we started My Pustak, a basic question came in our mind. What about those who don't have access to internet and can't even afford shipping charges? To understand more, we visited to underprivileged section of society, understood their book needs, and decided that let's load our bag with books and distribute them to the readers who are residing somewhere in slums where affordability of books are far beyond their imagination. Our team interacted with one such family. Let's see what they have to say. नाम है आपका?
Okay, shall we start?
Yes, Alankrita, you can start.
Okay. So first I'll introduce. NITIE Finance Conclave is an annual event under the aegis of Avartan, one of the top B-school events. The annual event has played host to many productive business conclaves, inviting leaders from diverse industries to share their views and perceptions on the current economic and financial scenarios. These conclaves also provide global golden opportunities for students to gather a better understanding and generate deeper ideas, enabling them to contribute immensely once they join the industry. For this year, the objective is to dissect and understand the state of India's economy and its recovery post the pandemic and its impact on industry, government, and the world at large. We are thankful to our respected Director Sir and Dean S.A. Hemadate Ma'am for their guidance and support, but due to last-minute changes, they couldn't join. Now I would request Professor V.B. Khanapuri Sir to inaugurate the event. Professor Khanapuri Sir is currently the Dean-sponsored Research and Industrial Consultancy at NITIE. He has 25 years of rich experience in academics, which includes teaching and research. Prior to joining, he has worked in the industry for 6 years across different functions in manufacturing supply chain. After completion of his fellow program in operations management from NITIE, he joined NITIE as assistant professor and is now a full-time professor. He has held different positions of responsibility, including professor in charge and program coordinator for the project management program and dean academics. His areas of interest include project management, procurement and supply management, industrial engineering, and information technology applications. He has been actively involved in various industrial consultancy assignments and social entrepreneurship activities at the Institute. Welcome, sir. Now I would request Sir to address the audience.
Thank you, Alankrita and the organizing team for having me here. First of all, a warm evening to all of you, the distinguished speakers. I extend a very warm welcome to all of you. My faculty colleagues who have joined this event online, and all the invitees and the students who are joining from different places. It gives me a very immense pleasure to welcome you all to this finance conclave on behalf of NITIE fraternity. And the topic is very apt. In fact, the road to recovery during and post the pandemic. In fact, at NITIE, we have been having these kind of student event, annual events, which are kind of legacy of hosting the stalwarts like you who come here on this platform. Of course, now we are meeting digitally, but then it is always a great occasion all the while to meet you all, whether it is digitally or physically, who share their insights on the various aspects of the economy, who will share their perspectives. Now, before I give my thoughts, I thought let me put some views on the topic. Probably what I have got from the secondary source of information, and though not my core area of research, but all the while it does impact each one of us. Now, the first thing which caught my attention, at least in the recent past, has been how our GDP has been shrinking, at least in the April to June quarter. And probably this is one fact which really caught my attention, saying that, okay, what happens next? I went into a little bit of further detail and figured out that, yes, it's not just what the papers are saying, but then even the IMF also is projecting a kind of contraction in the GDP growth, which is expected to be around 10.3% as far as 2020 is concerned. probably this is the highest contraction amongst the 10 emerging markets. And probably this is another kind of thought which gets reflected. If we are going to contract by a double digit number, then what happens? How do we recover from here? Now, probably these are my, I may be very a naive person to raise these things, but we have experts like Nitin and others who will definitely throw in their viewpoints and what kind of strategies have to be adopted. Now, the other dimension which comes to my mind is about what happens to the fiscal deficit, which is another dimension which needs to be looked at. What happens to the kind of retail inflation, which is a kind of concern. Now, probably some sectors did quite well. One of the sectors which I am aware of, yes, agriculture did really better than what other sectors could do. Manufacturing, of course, because of the closure, lockdown, things came down. I mean, they came to a standing point, and then we didn't have much of the activities going on. Other than that, probably we can also look at, okay, how the exports have made an impact, or what kind of impact it has been on the export market, the credit growth. I mean, I can keep on adding these points, but I'm not the right person. But I'm only just trying to give some kind of thoughts, initial seeds, some initial thoughts. Probably the experts were there. My colleague, Professor Ajay Panda, who is an expert himself, will be able to talk about what should be our way to recover from here during what we are now going on through, and what will happen after some time. I'm sure the vast experience each one of you brings into the table will definitely reflect upon your learnings in the industry, the excellence what you have been able to garner over these years, and your illustrious careers. I'm sure there will be a kind of music for the ears of the students and the faculty, who will definitely get this opportunity to learn a lot of things. I'm sure this conclave will be a lot of have a lot of significance to the fact that yes, finance and economy are probably the most important, or what we call it as the cornerstone, or the foundation for many of the economies to grow. And hence, this particular discussion, probably from the experts, will have a lot to say. How do we look at the business, the environment, and all those aspects will be touched upon. Just for a quick insight for the benefit of my industry experts here, NITIE has always been at the forefront, being very, very adaptive, in fact, agile. I'm sure you would have come across certain things. We have been introducing new courses, new way of bringing in the kind of insights. Of course, this is one way where we bring in the experts and help the students to get aligned with the industry requirements. But very recently, we have also introduced something called as microcredits, which means the students, along with the curriculum, will also get an opportunity to actually learn a little bit in more detail. And I would definitely be happy if you, a few of you, can really actively take part in these kind of microcredit courses also. Well, not a long talk to be made by me, but all the way, I thank you all for coming here, and I'm sure the insights will be will give a lot of good insights into the topic. And let me now keep this close this talk and hand over back to Alankrita and go ahead with the proceedings. Thank you all. And once again, I extend you a very, very warm welcome. Thank you.
Thank you, sir. Now I would like to introduce our panel members. Mr. Nitin Khanna presently holds the designation of Chief Financial Officer for Inorbit Malls India Private Limited, a K. Raja Raheja Group company. As a leader of the financial and commercial operations, Mr. Nitin Khanna is accountable for the strategic, financial planning and controls, accounting, revenue assurance, risk management, supply chain, and legal compliance of the organization. Nitin is a chartered accountant and a cost accountant with more than 2 decades of experience in working closely with the board of Indian companies like K. Raheja, Blowplast, Blue Star, and global leadership teams of Fortune 500 MNCs like Castrol, BP, and VF Corporation. Before joining Inorbit Malls, Nitin was CFO, India and Mauritius for VF Corporation, a US MNC managing brands like Lee, Wrangler, and Vans. Welcome, sir. Mr. Himanshu Mehra is the Global Sales Manager, Egencia, which previously worked as Vice President, HSBC. He has experience in corporate and commercial banking roles across HSBC, Citi, and Yes Bank for more than 11 years. Over the last year, he is working in the technology sector at Expedia Group as a global sales manager for Expedia's B2B business managing and APAC region. His experience spans across sales and relationship management with large, mid-market, and small corporate, and acquired expertise in international business development and managing relationship across geographies. Welcome, sir.
Thank you. Thanks.
Asta Gudwani, ma'am, is an economist at Banks of America Merrill Lynch. She is an associate in APAC research covering India economics. She was previously the India economist on the fixed income desk at Aditya Birla Sun Life Mutual Fund and worked there for 5 years. She has been with Bank of America Global Research for 4 years and has been covering Indian economics for close to 9 years. Welcome, ma'am. Ranjani Thakur, ma'am, is a micro-strategist with experience across policy, consultancy, and banking industry. She is currently working as an economist at RBL Bank for around 4 years and was previously the macro strategist at Deutsche Bank for 3 years. She has also prior experience as economic researcher at Dubai Chamber of Commerce and Industry. She is an alumnus of London School of Business, where she completed her master's in finance. Welcome, ma'am.
Thank you. Looking forward.
Thank you, ma'am. Professor Ajay Kumar Panda is our accounting and finance professor and professor in charge of Street. In addition to finance and accounting, his areas of interest are time series and financial modeling in applied econometric in various stats, software, and Python. He has published multiple journals, research papers in the area working capital management, working capital finance, capital structure, finance market interlinkage, and return volatility. He has collaborated for projects with esteemed institutes like Reserve Bank of India, Indian Institute of Banking and Finance. Welcome, sir. Now I invite Professor Panda, sir, to take the session forward.
Thank you, Alankrita. Okay. So, very good evening to all of you. Respected director, sir. Unfortunately, you could not able to attend the meeting. Respected Dean Professor Khanna, distinguished speakers, my dear students, media persons, okay, and my support staffs. It's my great pleasure to welcome you all to NITIE Finance Conclave 2020. I remember one thing, last time, almost last year, this NITIE Finance Conclave, we are debating about 5 trillion economy. So the possibility, okay, with the present growth rate, how long it will go, how much we will achieve, what should be the expected growth rate to achieve in 5 years, if at this growth rate, how long it will go. सपने बहुत बड़े थे लेकिन पता नहीं था रात इतनी छोटी होगी. Okay, and आंखें खोली तो कोविड. And today we are discussing about path to recovery. See, the topic is so vast that it has enormous scopes to debate. Wherever you start, it will, so we try to concise it to few points, just introduce, because today evening we are lucky enough that we have such a galaxy of industry expert, economists, okay, so that we will able to have, they will enlighten us and my students about this. I'll just briefly introduce. If I link it, just let me develop a platform where we can start our debate. If I think that time also in 2018-19, economics was also slowing down. Okay, so we are that time also debating that we are trying to find out that what type of slowdown it is. Is it cyclical, structural? Okay, so many of our arguments were coinciding with cyclical pattern and less to be structural, thinking that probably this type of slowdown is a natural phenomenon in most cases of generally post-reform periods. That time already Indian economy was experienced demonetization, GST, a big structural reform ever since our independence. And it has a structure that post-GST, the economy is expected to take a J-curve kind of thing. So that means at the post-recovery, it may take a long breath. Okay, then after that, it may recover like a hockey stick curve. Okay. But before we realize that, now the structure of the economy again changed. Okay, now no point to claim that this is cyclical. Now a structural reform is barely needed with this. What is the challenge going on? The first channel, if you look at the government, the policy is reserve is drying out and expenses, okay, are huge. What the government will do, there is no control to control other than ending up with huge fiscal deficit, and it has different repercussions to go about. If you look at for the very, in a micro point of view, if you see one hand unemployment may lead to lack of effective demand, and it may channelize into industry with lack of supply revenue. Of course, demand is less than shrinking the sales revenue, and then again it will enter the balance sheet. Okay, then it will end up with profitability risks, whatever, structure, even solvency parameter, everything it will be replicated. Okay, and it starts with that lack of income in the hand, and government has very beginning and realized that we have to boost. Various reforms has already taken place. Then what type of reforms? If you see that one dimension, fiscal dimension, another dimension is monetary dimension, fiscal policy and monetary policy, or you may take at the external policy. Okay, so if you look at, see again, if I go to the pure academics point of view, then if had we been some few academicians, they would have started debating whether the classical point of look at whether supply creates its own demand, that production should come fast. Okay, or Keynesian part that no, consumption pattern should be impacted. But now if you look at that, if you see that both the supply as well as the demand, that is the consumption pattern as well as the production pattern, both has to be taken stimulus impact. Then where to start? Okay, whether this pattern of this balanced growth, that government is trying that to boost the consumption pattern. If you look at the fiscal side and the monetary side, interest rate is as ever low. Okay, if you see that almost 1 year fixed deposit, 2 year fixed deposit around 5 to 6%, risk-free rate 5 to 6%. If you compare the inflation rate, it is almost, if you see that almost real rate of return is equal to zero of the economy. So it is ever low. Okay, and now the fear is, since in a household sector economy where consumption, even though we have the advantage that India is an young economy, we have a strong domestic demand pattern, that in spite of the export, our internal demand can boost our economy. Then we also always take that advantage that we can lever our internal demand as a most robusting factor, unless and until we could not able to export. Okay, so that is the parameter. But what the other side, that our interest rate is equal to historical low level. We may think that if it will go below, then a household sector may not be encouraged to save, isn't it? So almost we are in almost approaching to a liquidity trap situation, that interest rate is good. So how industry is going to take it out? Okay, there are various consumption boosting patterns. if you ask the government that the many expenses starting from Manrega, so there are consistent effort from the policy point of view that leads to boost the consumption pattern, to support employment, to support income, so that some sort of consumption can be maintained, so that industry can be motivated. So my point of view is just to put that now instead of aggregate, we should look at our micro prioritizing the policy, even if the monetary sector, even in the industry sector, there are policies. So where should we start? Which parameter we should focus so that it will have hit the point where we are expecting. Anyway, this is the growth, broader aspect of this. Now, if you look at, when I see Mr. Nitin Khanna, it came to my mind that I will definitely ask her. See, the thing is, right now market is almost, economy is closed, and sir is the CFO of Inorbit malls. So I will definitely expect, okay, that Mr. Nitin Khanna to focus on, how this revival pattern, consumption pattern, how do you think that this changing of consumer behavior, particularly, what happens to this, revenue is shrinking off in your, the unit, what you are. So I request Nitin Khanna ji, please enlighten us, okay, with your practical experience, what really happening, okay, to our students. It's over to Mr. Nitin Khanna ji.
Hi, good evening, everybody. Are you able to hear me?
Yes. Your voice is
Okay.
little slow, but audible.
So, first of all, good evening to your respected professor, Professor Khanna and Professor Ajay Panda, my peer set on the panel, and of course the dear students. It's an honor to address one of the most esteemed institutions of the country, and I would say one of the sharpest brains in the management field. Since I'm first one to start, let me start by wishing you all and your families a very safe and happy, festive season on behalf of the entire panel. Let's start with something really positive. We have been hearing a lot of negative things about it. So let me start by wishing you all and your families a very, safe and happy festive season. As Professor Panda rightly said, I represent mall industry. So in the pandemic times, we were the first one to get closed, and probably last one to get open. I'm the one on the panel who will be talking more about nuts and bolts. I will leave Rajni, Himanshu, and Asta to talk about the macroeconomics. So, just going back to today's topic of discussion, which is road to recovery during and post the pandemic. As I'm addressing this to, of course, the future CEOs, CFOs, economists, in the future. In next 7 to 8 minutes, I'll be talking about my learnings during the pandemic, and I'll be a little bit more talking about individual areas, what learnings have been, and also how I am programming myself and the organization in this road to recovery. So few of the pointers, few of the positive pointers have been, I just heard that the GST collection is back to the normal ones, and the funniest part of all these KPIs is that the moment you start dissecting them, you will start getting some positives and some negatives, and it's quite comparative. When I go to my mall head says, sir, my Baroda mall is 75% of the normal consumption of last year. I said, great. Which segment is growing? And he said, my electronics is more than last year, and my fashion is like 15% of the last year. So you see, there are two extremes, in terms of growth, in terms of industry. So one side is hugely imbalanced towards the consumption pattern, and there is another side which is, some of the segments are yet to start. So again, a little dichotomy in terms of revivals. I'll also talk about the phases of pandemic. When we go back and look at our learnings, I'm sure I heard what professor have been teaching in accounting, managing the working capital. I think the first stage was when this pandemic hit us hard. From a mall perspective, our revenues are basically from the retailers, and they were zero. First 4 months they were zero. I still remember those discussions in the month of January, February, pre-COVID, when we were talking about 5 trillion economy, big picture, looking at how we are growing multiple, which segment, big picture, functional, functional leadership and all. Uh, in the second week of April, the only thing which I remember was cash. And as somebody has rightly put, that revenue is vanity, profit is sanity, and cash is reality. We kept I remember, Professor, this is something which we read so many years back. This came as a huge refresh for me. uh, for mall business, it is more than now 4 months of complete zero revenues. So talking about revival, I still feel that the revival is still far off. A lot of basic things we did at the start of this pandemic. We started changing the fixed contracts into variable. There's a huge OEM industry which comes to the mall, and we are capital intensive. There's a huge fixed cost which were sitting on our balance sheets, on the profit and loss, which we started, kind of cannibalizing it and making it variable. We requested everybody to share the pain, all across the industry. And we have 625 retail stores in our 5 malls all across India, and the entire retail segment was in complete doom. So you imagine, Professor, going back to all the entire industry, as you talk about F&B, you talk about electronics, you talk about fashion. There is a representation of all the industry, even the auto players, represent, sometimes come here and put their models on display. And again, it's a source of revenue for us. So every industry was coming back and negotiating with us and saying that we don't have money to pay. I remember on the top of the mall we had signages. Even the Samsung signages was actually taken off. So it was a huge learning for us from the first phase, that this world is a VUCA world. We have we should be aware of the bigger picture, which is macro, but it's important to go back and refresh ourselves. When the time comes, as Professor was talking about the value chain and his expertise in supply chain. I remember when a time comes, you should be able to kind of put up your sleeves and then go down and start with the basics again. So big learning for me. The second phase is of course the financial management phase, where the malls started opening, and the retailers coming back started negotiating with us, and we said, okay, fine, let's share the pain. And this was the time where we started representing to the government. This is again the second point, Professor, when you talk about regulators. Frankly, if you ask me, we haven't got any help from the retailers, regulator as of now. Whether it's government or from any corporation, municipal corporation, I don't see any help come. And of course, my fellow panelists will definitely add on this. And we made representation from down to the basic city civic office to the highest finance authority in India. And that was the kind of representations we made. And we asked them to give a help in the interest rates, look at the loan restructuring, look at how you are looking at our taxes, give us some waivers in terms of taxes, reduce taxes to some of the products, like segments like F&B was struggling a lot. So frankly, no direct help. Now we are talking about indirect help. We're talking about how can more money be in the hand of consumer. And you would have seen the recent LTC, which has gone to central government or private. I don't want to comment on this forum, but I don't see a huge help again coming back in terms of consumption. You are all experts. I don't see that people coming in and consuming that extra amount of LTC in my mall, and then they start looking at bills, whether it's 12% GST or a lower percentage than that. So government is trying to help, but I think there has to be somebody who will be really guiding them strongly as to what should be the focus and what should be the direction of that support. I think the last part where we are into now is controls and operational stability. The third thing which you talk about, employment generation. So I'll just give you one figure. on an average, mall has more than 2,000 employees in one of the malls. So you talk about 5 malls, I have more than 10,000 employees directly and indirectly, whether it's at worker level or at a senior management level. We were working with one third the capacity and maybe reduction in salaries. So from that perspective, coming back and looking at revival, I think over the period we have got back some of the migrant workers who had gone back to their hometowns. They have slowly and slowly joined. I would say 30% have joined. We are still struggling to get quality manpower. We have manpower, but we don't have a quality manpower around that. So we're trying to induce them to come back. Few of the agencies which we have been employing have been told to, help them, support them financially to make sure they come back on time. There's a lot of discussion which is happening on online, and I'm sure with all the students and millennial population, there's a huge consumption which has gone to online, and there have been questions whether offline will survive or not. So far as India is concerned, I would say Indians are more social animals, and malls are more accessible social places for them to refresh. I'm sure whoever is there on the panel, including to rejuvenate and spend time with their friends and families in the malls. The growing congestion in cities and the stresses that come with daily life and the lack of quality open spaces, I think makes malls a focal point of social behavior, I would say. I personally feel that the mall culture is there to stay, at least from an industry perspective. And I think over the years, the malls have also transformed, as an industry from a place where you can shop to, experiential places. Talk about more of experience while you are shopping. So organized retail, when you talk about organized retail, the organized retail penetration in India is about 9%. And, when pre-COVID days, we were discussing about 20 to 25% in 2025. From a mall industry perspective, more than 20% of the average mall have closed during this time, and they are ready for sale also as well. There are quality assets which are yet to be in the market, but yes, there are average assets from a real estate infrastructure perspective which are there in the market. So we are expecting more quality assets, retail assets in the near future. What we are also expecting from the government is to ease off certain stamp duties, certain property taxes, certain GST relaxations in the coming time, so that real estate industry can actually come back to the normal ways. Now I'll take a pause and hand over the stage back to Professor Panda to take this discussion forward to other panelists.
Thank you, Mr. Nitish Khanna. See, now we realize what is the difference. Okay, so just stating in the policy statement that this is how incentive, and when what we realize at the grassroots level, that is really different. Okay, so that's why I said I had a feeling that instead of macro, we should always look at microstructuring the policy priorities, that where it is hitting a lot. Okay, so this is very good, very well explained, really. Okay, so very good takeaway point for our students and for the attendees. Okay, and that the real life experience of the mall business, then where is the policy and how really happening, and there is a gap is clearly visible. Okay, thank you, sir. Okay, so at one time we will open the platform for the students. Okay, so now I would like to request Mr. Himanshu Mehra. Okay, he's the global sales manager. So Mr. Himanshu, the dice is yours. Please enlighten our students, okay, about your experience.
Thank you, Professor. Thank you for the time. I think thanks for providing me this opportunity to share my experiences and giving me the space and time to convey my message as such. First of all, it's great to be back at NITIE, my alma mater, and obviously it's even though virtually this time around, but obviously great to be back any time of the day. I would start off by thanking the dean, all the directors, professors involved, the staff, and the students in making this a virtual, even though a virtual event, but I think a successful one at that, considering everything that's happening around us today. And I think that really shows the resilience of humanity as such. I think we've gone through all odds and we've still come out the other side, trying to find our ways of how we can maneuver this. I think just starting off from the point that Nitin addressed, I absolutely concur on the part that we are all social animals, and I think it's not just India. Globally, everyone is a social animal. We thrive on interaction. So whether it's digital interaction, I have my own thoughts about digital interaction. It's helped us a lot during this time. But I think I would any day want to have this conversation face to face. It's a different conversation. We've all been on the business side where we've had our meetings, and the success of a face to face meeting is obviously very much different from what online interaction is. Not to demean online meetings. It has provided a great platform for us to continue our work. But I think, as Nitin mentioned, we are all social animals. We would want to move out, go out on vacations as soon as it's safe. Everyone will want to do that. So I think, coming from that point, I absolutely agree. I think just getting onto the point or the topic, which is road to recovery, as you said, it's absolutely pertinent in today's state of affairs that we are in. So I thought, from the topic's perspective, that we should actually look at what is the Indian economy recovering from. So a plain and simple answer to this would be obviously the COVID impact and the devastating impact that it's had on the economy, the livelihoods of people. But if we delve a bit deeper into it, we'll understand that it's not just the impact of COVID which has harmed the economy. Even pre-COVID, our economy wasn't doing really too well. We had twin balance sheet problems. We had a slowing down of the economy as such. And COVID, what it has done is it's actually accentuated all those issues multifold, and sort of has taken it to the next level on the negative side. And everyone's just left thinking, as you guys said, the 5 trillion economy is what we were debating last year, and obviously we're discussing on the road to recovery this year. So I think I'll start off with COVID-19, and I think my view here is that it's sort of a humbling virus. It's humbled humanity, and I think the virus doesn't like arrogance. So any country which has said that we've defeated the virus has come back with a vengeance, and we are already seeing second, third round waves of the virus coming through. We are actually seeing second rounds of lockdowns coming through. India's doing in a much better shape than we were in the past few days, past few months, and hopefully we never go back to that place again. So I think from my side, the first thing that we need to do is we need to have the COVID virus at least under control, not growing at the pace that it was. And though it's a difficult challenge, but I think what we've been doing correct needs to be replicated so that we keep doing the positive things right. So I think to drive consumption, to drive the positive sentiment in the economy, that will definitely be needed. For people to go out shopping, for people to go out, for a vacation or anything of that sort. I think they just need to have that mindset that it's become a bit more, bit less riskier as such. I think that'll definitely help. Now, what are the methods to control the virus? I think that's anyone's guess. Whether it was complete lockdown that India did, which obviously we know what's happened to the economy, 24-25% decline in GDP. But even if you look at a no lockdown situation, which Sweden had done, or a few other countries had done, they really haven't achieved herd immunity. So it has to be sort of a balance between both of these points. I think what I learned from this was that governments can actually be nimble and agile. We always thought democratic governments were like big elephants, which were sort of took their own time to take decisions. but we saw quick decision making in most of the countries. I think we have to be appreciative, and I think what has happened is that obviously each part of the economy needs to be addressed now. But overall, I think they were quick and agile, not to at least our expectations, and at least you can give credit to the government for that part at least. I think what the government is sort of trying to do is like a trapeze artist walking a tightrope. So it's balancing fiscal stimulus versus fiscal prudence. So India has given about 1.2% of GDP as fiscal stimulus, which is obviously needed, which was needed to stimulate the economy, to get people at least their livelihoods, whatever way you can save them. But India really doesn't have too much of headroom, or had any headroom for any maneuver or of large fiscal stimuluses. What we obviously risk is a sovereign credit downgrade, and if that happens, we've recently seen what happens to Sri Lanka's dollar bonds. Sri Lanka's dollar bonds went down by about 35% in 2 months. They were one of the best performing dollar bonds till August, and once that credit rating got downgraded, they're down 35%. We obviously don't want that sort of a situation happening in India at all. So I think that's why I say it's sort of a mix of balancing between priorities of fiscal stimulus, fiscal prudence, and I think that's the tightrope that's why I say the governments have to be really agile and come out with more better positive aspects to solve stress sectors of the economy now. Now I go back to the initial discussion saying that what happened pre-COVID. So pre-COVID, we were in an NPMS with the banks. We saw the ILFS crisis, the NBFC crisis take shape. Or what all that did was it reduced credit offtake. It sort of slowed down the economy in general. So maybe somewhere in, I think the economists on the panel can obviously shed light on this a bit more, but I think the Indian economy really needed some sort of overhauling at that stage, though we were talking about the $5 trillion economy. COVID, again, what it has done is it has provided that platform for the government to sort of take those structural reforms. They've do big structural reforms. Hopefully they'll do more structural reforms which can do more lasting impact for the economy. So I think kudos on the points that they've done something for the agricultural sector, which obviously is done well. The agri reform hopefully will be positive. The performance-linked incentive scheme, PLI scheme, is also something which is a step in the right direction. Now it's up to the implementation. Now it's up to taking it to the next logical step, so that the fruits of those structural reforms can be borne by the communities as such. I think talking about the green shoots that we've seen, Nitin talked about the GST collection data. That's obviously a good point. There are various proxies. Diesel consumption has increased. E-invoices have increased as compared to what. So obviously there are various proxy data to look at and assume that the economy will do better and will come out of the rut that it is in. But I think from my view, what the government now has to do, and hopefully they will do that, is they now need to really look at the stress sectors of the economy. They did something overall. I think they really need to be a more focused approach, saying that these are really the stress sectors of the economy. As Nitin rightly said, malls are one, tourism is one, hospitality is another one, which is really down in the dumps. And these sectors employ a large population of our country. They contribute significantly to the GDP of the country. So these sectors really need to be addressed in the next round of fiscal measures that the government comes up with. I think in the end, what I would like to say is that the road to recovery, I would like to actually divide it into three parts. One would be the government, what hopefully they do, the corporates, and us as individuals. So I think what really they need to do is, again, the tightrope walk has to be done, but they need to come up with financial interventions or fiscal interventions at appropriate time. Whenever they see the data is not in line with what is expected, or a particular sector is not doing too well, they really need to have that focused fiscal intervention there in place, and obviously continue with the structural reforms that they have started and they were doing earlier. I think continue with those reforms, get them as quickly out of the table as possible. I think for corporates, tech adoption and digital push is obviously something which is coming in. Not to say that what we talked about, the social animal aspect, everyone wants to meet, but I think how you can bring efficiencies within your own system through technology adoption, which weren't there earlier, and you can save some costs there. I think every sector which is not making revenue or has reduced revenues will try and reduce expenses as much as possible, and hopefully technology can solve that part for the corporates. So I think looking at that, and the second, obviously conserving cash is king, and working to strengthen the balance sheet as much as possible. I think those are two things. Last, I think for individuals, what I would say is that all of us have to learn to live with the virus. It will take its time. We are seeing some green shoots, as I said, as we've been seeing. Hopefully, the economic activity will come back up faster than we've presumed it. Again, that's a hopeful, positive statement, being an eternal optimist. But I think we need to really learn to live with the virus. What we typically, and I've seen a lot of people do that, is we tend to look at headlines which come up daily and sort of get into the negative mode of things. I think look at the larger picture. See whether it really has that impact on you individually as such, and if it doesn't, just shirk it off, get to your work, and get on move. Because in the end, I think the road to recovery may be bumpy. It may not be as smooth as is planned, but I think and what we will as individuals do well is to know that it may get worse before it gets better. So I think that's if we can be mentally prepared for that, I think we will do well for our organizations, for ourselves, and for the country in general. I think that would be my parting thought as of now, and I'll sort of hand over the baton now.
Thank you, Himanshu, for beautifully linking the issues of COVID with various aspects of the economy. Really, I do agree with you, Himanshu, the beautifully you said, identifying the stress sectors of the economy, particularly mall or hospitality. Okay, yes, we should identify and we should prioritize. This is very beautifully identified. Another point I really like about the fiscal intervention at the appropriate sectors with technology innovation. Really, this is a very good point that policymakers should pick it up. Okay. And we are really very interesting point coming out. Okay, you just you just took the matter where Mr. Nitin left. Okay, practically we are linking. Now I'm looking forward with Ms. Ranjini. Okay, to listen your thoughts and viewpoints on the topic. Ms. Ranjini, over to you.
Thank you, Professor Panda. Always a pleasure to be a part of an education institute. There's so much for us to learn many, many years after we've left our respective homes. So always a pleasure.
Madam, just intervening. I am just we this time we missed to host you in our campus. Okay, so let the COVID over. Whenever you all free, you're most welcome to our beautiful campus. A live interaction with the students is very we are just missing it. Okay, we are missing our auditorium. We are missing to host you in our campus. Okay, please continue, Ms. Ranjini.
We're missing it on the other side of it. So happy to be a part as and when things open up.
Yes.
And big thank you to all the fellow panelists. Always very interesting to hear different parts. And I agree with both of you on most of what you said. As an bank economist, my job actually entails talking to different sectors. And what you said, Mr. Khanna, is pretty much what everybody has been talking about in terms of no real support from government. Where are these policy announcements coming from? So with you, not only me, but I think across the sector, that's a thought that resonates. And, as Himanshu kind of mentioned, that it's a bumpy road. Most of my time actually goes in connecting the dot, because I've kind of realized, not only as student, even when we are practitioners in our respective field, we are very busy with what our own business is, what our balance sheet is looking like, and probably a bit taken into what the financial headlines read in, So connecting the dot is what we miss, and probably that's what experience brings in. I myself as a student would feel very, very lost in terms of so many FDI approvals coming in, so much of foreign money coming in India, and then there are so much of stress sectors happening here. What is happening? Are we growing? Are we not growing? Or are there some companies that are growing or some that are not? So I will try to cover it in two parts. One is, and I would kind of advise the students also to look into short-term versus a long-term story. And Indian economy has a very different pre-COVID, post-COVID recovery story versus a long-term issue, which is what Himanshu touched on. We were at an 8% growth rate in April 2018, and we were at a 3.9% growth rate in April 2020. In fact, thank God for COVID that, we're not talking about a bad growth rate. We've got an excuse. Otherwise, we would really have been one of the worst growing economies in the world. So that's a big one. Long-term growth story. What's ailing us as an economy? What are the sectors? What are the pain points? And short-term pre-COVID, post-COVID. Pre-COVID, post-COVID, as Mr. Khanna covered very well, there are sectors that are back to 75% of pre-COVID levels. Could be electronics and could be online sales. And there are sectors that are still on 15%, So UVL, but RBI calls it a 3-engine growth. We are looking at probably a 5-speed growth, different sectors growing at different pace. Very easy to figure out which ones are growing faster and which ones are not. So, for example, a rail or any service industry, airlines will only gradually recover. And something like a passenger car or two-wheelers or rural sector doing well, hence the tractors and fertilizers, they will recover very, very quickly. I think when we track sector, it's important to figure out where are the workforce vulnerability lying. Because any pre-COVID, post-COVID recovery will be a story of second round impact once the health crisis is over. At the end of it, it's a health crisis, right? So any economic recovery only begins once the health crisis is over. Once it is, there will be some sectors where workforce vulnerability is very high. So these are the sectors where job losses are high, income losses are high, and it will play out in the overall demand plan. So however much cheap assets might be available in the economy to buy, be it cinema halls or malls, it will be difficult to sustain if the income levels, demand levels don't match up. This reminds me of sometime around 2013 and when I landed in India after almost a decade. And, there was an all-pervasive pessimism. Then Modi government came and everybody was like, this is the moment. Now everything is getting pro-business. And we saw the kind of jadedness seeping in the business sector. I mean, if you remember the NBFC crisis that happened just a year and a half before this, there was this whole thing about credit squeeze. And by the time the policy support could come forward, we already had suffered on the financial sector. Essentially, what is happening, and that's something that's important to keep in mind, is 2011 is when we see a peak of capacity creation overall at the macro level. Why is this important? Post global financial crisis, there was this whole support on the monetary and fiscal side. It stayed in the economy for a while. And it created lots of capacity. Money was cheap available globally. It created lots of capacity. And we see a whole surge of people, ECBs, people going abroad and borrowing money, creating malls, creating cinema halls, creating industries. And thereon, we see a capacity utilization level kind of constantly falling down. In fact, till before COVID hit, we were at a 75-76% of a capacity utilization at an aggregate level in the economy. Now, as a rule of thumb, you cross 80% when your real new investments start. Why is that important? Because that's when your actual income creation starts. We have not seen that in our economy in the last 5 years. So if incomes are not being created and consumption is happening, it's being leveraged on one or the other. The corporate balance sheet, moving on to bank's balance sheet, cleaning that up and moving on to government's balance sheet via recapitalization. But basically, it's the pain where you have leveraged, we have created, and your income levels haven't come through. Your demands haven't been met. And hence your leverage is now getting difficult to pay. So it's a multi-year cycle that's been playing out. So despite all the good September data, we are probably back to the post-COVID recovery. In fact, I have a high-frequency indicator that's giving me barely 8% at an aggregate level below the pre-COVID levels. I think this one is here to stay. A clear solution onto how do we move from here. Services have been a big sector, have been supporting income levels. Services only get demand when income levels are rising. We've had a flat wage growth on an average, if we kind of take away the sectoral comparisons. So at a time when your wages are flat and your incomes are not growing and your consumption is growing, you are creating vulnerabilities in different balance sheets, household, corporate, government. And pre-COVID, we see a world where there is an enormous amount of risk aversion. Nobody wants to come forward and spend. Nobody wants to come forward and invest, including government. It's tied, it's by its hand. Every sector is complaining about no real support. It doesn't have enough money. And it's running risk averse as well. It doesn't want to risk crossing its fiscal deficit numbers. It doesn't want to risk upsetting the asset market. It doesn't want to risk and hence invest. Now, at a time when all the economic agents are running shy, the only agent that can come forward and consume and invest and hence restart this cycle is government. So finally, the solution is that we cannot be accumulating forex reserves in our central bank and not spending because we have fiscal limitations. Only one agent can front load this, and that agent is government. Sooner or later, it will happen. Delayed, yes, I agree. Like NBFC crisis, lots of these reactions are coming a bit delayed. By the time the realization seeps in, some loss has already occurred. But that will be a clear signal of getting back to a sustainable growth path. Till then, we are from one financial account to other financial account to the other financial. We're covering it up. And you've seen that in policy as well. Most of the support that has come has been on the monetary side, has been on the cheap credit side, but government won't borrow. It wants the corporate to borrow and pay its loans. So, there's a difference. We're still on the monetary side of it. We have to get to the real economy side. And that will only happen once we see some investment coming forward. We see some income being generated, which has not been positive for last 6-7 years now. And then we see a sustainable growth story. Having said that, all our essential strong points, in terms of young population, education, everything stays. So if we manage to tap it, and that's why we see so much of FDI coming in. There are projections by McKinsey that tells you some of these city economies, Mumbai and Ahmedabad, would be equivalent to some of the big EM markets, Malaysia and Vietnam. So there are one-to-one comparisons on how some of these city economies could be as big as a big EM market. And all the finances would flow. But right now, and because we are a capital scarce economy, we don't have enough capital to come out of the mess that's been playing for good 6-7 years. And till the time we address that, we see a financial sheet recovery. We really don't see a real recovery. And that's what is very, very crucial to kind of watch out for. Having said that, what does a pre-COVID and a post-COVID world looks like? I think some of the trends are very, very obvious, in terms of digitalization, in terms of online, in terms of sectors that will lead because we are gradually getting more comfortable with the digital world. 2-3 things are still very important to keep in mind. A, the consumer preference will change. So even for those investors who are investing in India for a long term, you'll see them kind of changing their investment sectors or the target sectors to the changing consumer preference pattern. And you will see more investments or more foreign capital flowing into that. Why do I say foreign capital? We're really capital scarce. We're still very dependent on foreign capital to fund lots of our further investment activities. And you will see some new jobs coming into that sectors as well. So that sectoral change is very, very important for students and for everybody to try to understand how is this moving. And I think another big change would be in terms of, this whole realization, and I've been part of many policy discussions in terms of realization that how manufacturing is important. For good almost 20 years, we've not really paid attention. I think ever since that whole IT wave took us over, and it did very good, we really didn't have any lead sector that was kind of, getting that gains into the economy. didn't see that kind of a job creation, that kind of a profitability level coming in. All of them were dependent on the incomes that were created in the IT sector. So we had real estate growing, we had many of these growing in, but real income creation was really not happening. That's where, there is now a broader sense on the policymakers that you have to identify your lead sectors. You have to identify which are the sectors that is going to create more employability and more income level. A. B. No longer in that denial where exports is not important. What you're manufacturing is getting towards exports. So it might not be important in terms of your overall composition of GDP, but it's important again to figure out where do our competitive advantage lie, because that's where our income generation will be much, much faster than the rest of the economy. So I think these are the two big post-COVID changes that I see coming from the policy side and on the sectoral side. But any road to recovery is about, are we talking about February, getting back to February levels, or are we talking about genuine recovery? Because February levels, we were still at 3.9% GDP. So we're pretty much getting back to what we, as students, used to call Hindu growth rate. So I feel it's very fortunate to get COVID at a time when, a 3.9 and a lower would have been really, really bad for us as an economy. Now, at least COVID has given us that much of breathing space to come back to a 5% level quickly and then figure out that, how do we push our potential growth rates higher? So I think that's what I have in terms of big picture, could get into assets, could get into fiscal deficit numbers, how government is financing it. But I will pass it on to you, Professor, and, take it from there.
Thank you, Randini. So it's a very beautiful and heavy load of stuff, okay, from an economist point of view. You really pointed out a couple of points I really liked about your short-term and long-term diversification, capacity utilization, and how beautifully you said that financial recovery is the true recovery, okay. So unless and until you financially recovered, okay, so we have not yet recovered. At the end, money matters, right? So, and mostly another point that we should, from service sector to manufacturing sector, prioritizing the manufacturing sector. Yes, that is the most crucial part. Okay, if you see that our contribution of manufacturing sector was just double digit, very, very low, and it has lots of potentiality to grow. Okay, and finally, so one more point that you highlighted about, the export, that is really good. Okay, so we have to take the advantage of our international. We should not look out our internal economy to recover. Rather, we have to also extract the benefit of our international competitiveness. Okay, we always say that even though we are negative, but we are less negative. Let's capitalize being a less negative economy. Okay, so even though our currency is dollar rupee is depreciated at this much level, still our foreign exchange reserve is increasing, export is somehow going up. So somehow to some extent we have leveraged. Okay, so we try to utilize depreciated currency in some way. So similarly, we should not also forget about utilize our international competitiveness as well. Okay, thank you, Ranjani, very nicely on the economy. So we are eagerly waiting to listen another economist, Miss Asta. Okay. Asta, it's over to you.
Thank you so much, Professor Panda. It's actually a bit such an illustrious panel, but first and foremost, thank you everyone for having me up here. And I actually had thought that I'll break my opening remarks to first set a context and probably throw some numbers, because that's probably what economists are best at, about what was the great Indian lockdown like, and how were the various stages of the unlock from 1 to now 6 look like. So just to give you some sense of numbers, when India announced the most severe lockdown in the world on March 25th, we had a total of 553 cases, and we had a daily run rate of 85 cases. When Unlock 1 was announced in June, we had moved to a daily run rate of 8,500 cases. And when Unlock 4 was announced in September, we had a run rate of 78,000 cases. So where we were in March, when we were looked at countries like US and UK, thinking that their run rate of cases is 60,000 per day, how can they open up, and how are we in such a strict lockdown? Why can't we go out? What the time between April to June gave us was not a flattening of a curve or declining of the daily cases of the curve, but what it gave us was the time. the time to understand how severe this virus is, the time to understand what are the various gradient of getting this virus in terms of mild and severe, the time to figure out do we have the ability to make a makeshift health infrastructure? Can we make 10,000 quarantine beds in Delhi in a week? Can we convert a big stadium in the middle of Mumbai into a quarantine center? And most importantly, to identify what Italy unfortunately got wrong, who to give a ventilator and who not. So what happened between April and June was not fewer number of cases or less spread of the virus, but the time to make that makeshift health infrastructure and the time to understand the virus better, and finally to weigh the pros and cons of this big life versus livelihood debate that India was presented with as an emerging market economy with a per capita income of about $2,000. After June, people like me and a large part of the economics fraternity actually started contesting government's view that how could you open up the economy when daily run rate of cases is reaching 90,000 cases a day? And that's when it strikes in one of the most naive moments that this debate is no longer about life versus livelihood. There are people in the economy which make a bigger part of the population where if there is no livelihood, there isn't any life. And which is why the question of a re-lockdown, of localized lockdowns, was appropriately dealt by the government, dealt by the monetary policies. I'll now move on to just identify the big differences between what the Great Indian Lockdown looked like versus what the unlock process looked like. So when we announced the most severe lockdown in the world, we obviously had all our high frequency indicators collapsing. In the month of April, we had zero passenger cars, zero commercial vehicles, and zero two-wheelers being sold. So if you were to look at these chart books that we economists are so deft at creating, you will see nosedives to minus 100% YOY levels in about 15 out of 32 indicators, 20 out of 41 indicators. And that is what April, May, June looked like. And that's why there was no second guesses to see that India contracted by 24% in the June quarter. So not only were the high frequency indicators collapsing during the Great Indian Lockdown, what happened was a labor reverse migration, something very rare that happens in India and something that Mr. Khanna also referred to, that it was so unusual to see truckloads of people going back to their villages in any form and condition just because they did not have daily wages and daily livelihoods to rely on. And that created the problem that when the unlock will begin, will they even come back? Or do we need them back in the quantity that they left in? And that's what sparked the debate on the supply side disruption, the labor supply shortage. And this automatically led to hoarding of commodities, led to a sudden spike in inflation. For 2 months, economists like Rajni and myself, we had no CPI inflation data to monitor because there were no data collecting agencies that could go and find out what's happening to the prices of any other good apart from essential commodities. So here we were in a situation where activity is at standstill. Services which are contact intensive are nowhere to be seen. Reverse migration in labor is creating supply disruption. Hoarding is happening. Prices of essential commodities are rising. And you just do not know when will you come out of it. Come the unlock 1 starting June 8th. And you see the crawling back to life of macro variables that Himanshu referred to, the green shoots of recovery. Unfortunately, from an eternal optimist coming to an economist where pessimism is actually an occupational hazard, everything that Himanshu referred to, and I was so happy to see that there is a bright side to everything that even Rajni talked about, that COVID gave us the option to mask our low growth rates before anything hit us. But if you were to go to second level analysis of what the high frequency indicators right now are showing, you will see that the double digit degrowth in most of these indicators, be it passenger vehicle sales, railway freight traffic, PMI manufacturing, civil aviation passenger traffic, civil aviation cargo traffic, diesel sales, petrol sales, foreign tourist arrivals, well, I mean, that one aside, but everything else that was degrowing in double digit has now started to come up. So if I were to put it on a graph, you would see this nosedive going in here. These were the previous levels, and now you go see them going here. And this is what we are getting ourselves contented with, saying that we are towards the pre-COVID levels. But my current understanding is that this full year is going to see a contraction of about 7.5%. RBI's expectation for financial year 21 GDP growth is minus 9.5. So I'm actually relatively better off than the RBI as far as assessing the overall economy. This will also be the first year that India will see a technical recession because the first quarter growth was negative. In all probability, the second quarter of the financial year growth will also be negative. And as far as positive growth rates are concerned, my best case scenario was that it's only in the March 21 quarter that we see a positive growth rate. December at best will be flattish, but that's where I am on growth. I would also like to take some time to highlight a few policy responses by both the government and the RBI in this entire period, and then probably take that discussion forward to, is there room to do more? There is certainly need to do more. And if there is a room to do more, what is the uncertainty that we are all talking about? So firstly, kudos to the government to announce the self-reliant India or the Atmanirbhar India package. And I was so glad that Himanshu actually picked up that exact estimate of or exact number of the fiscal stimulus versus fiscal slippage. So I actually wanted to spend some time in explaining to the students that the 10% of GDP of Atmanirbhar India package that was announced, the fiscal stimulus impact of that package this financial year will actually be close to 1.5, 1.6% odd, and not the 10% of GDP. It was almost like a mini budget. It had something for everybody. It had free credit for MSMEs. It has NPA holidays. It has agriculture infra fund. It has monetary stimulus in the form of abundant liquidity to whoever needs it. It has things from street vendors, the Swanidhi program, to space centers. So the Atmanirbhar package with 10% of GDP headline was actually was an extremely wide, across the spectrum, big package, mini budget for the country. But does that resolve the immediate task at hand? Does that resolve taking the economy out of the mess that the COVID-related shock has put us into? Which is where it is very important to at least acknowledge that this is one of those rare economic crises which is not driven by a financial crisis. This is a crisis driven by healthcare, lack of healthcare infrastructure, and not because real estate or gold became a bubble, and not because equity markets overran, and not because bond markets in the US were doing very well, which is why the response to this crisis is more fiscal in nature than monetary in nature. And that's why the first line of defense had to be fiscal stimulus. And to put it on record, the fiscal stimulus is actually about 1.5% of GDP, and rest everything that we will see in this year's fiscal numbers will all be slippage. And that's natural. Economic growth results in excise duty collections. Excise duty collections fall drastically if economic growth is not happening. And at the same time, government expenditure needs to stay committed because you have to pull the economy out of the rut. So there is no way that we'll be able to adhere to the 3.5% fiscal deficit for the center. Our own estimates are that center plus states combined will actually see a fiscal deficit of about 12 to 13% of GDP. And I do see upside risks to it because we think that there is still room to do more, and there is a need to do more demand side measures. What we have done so far are supply side measures, are medium term measures. But what is needed right now is to take the economy outside of this immediateness that this healthcare crisis has dawned on us. Moving on to the RBI, I think exceptional work done by the monetary policies. 2 out of turn policy rate cuts, something very unconventional and something very nimble and very timely. So between January to now, RBI has already cut the policy rate by 115 basis points, but the overall rate cut have actually been even more, because currently when the economy is in an abundant liquidity situation, the effective rate in the economy is not the RBI repo rate, it's the RBI reverse repo rate, and that stands at 3.35%. So when Professor Panda was talking about record low rates, just wanted to make this small point that for an overnight investor, and even for someone who's borrowing money for personal loans or mortgage-based loans, which are now linked to the RBI policy rate, the rate is actually much lower. So kudos to the monetary policy for being extremely proactive, extremely timely in terms of coming out with out-of-policy turn responses to ensure that ease of liquidity is ensured And not just that, the communication that this is not over and we stand ready to continue to cut rates as long as our inflation target is being met was very well communicated by the RBI. Just talking a bit on the monetary policy, I'm sure that everybody knows that India's central bank, the Reserve Bank of India, is a flexible inflation targeter. They're anchored to CPI inflation, and they cannot really do much to rates if CPI inflation continues to inch up. And it's actually right now much higher than their target. So the mandate is for the RBI to keep inflation between 2 to 6%. We saw 7.3% CPI inflation for the month of September. We think that it's going to be in the north of 7% even for the month of October. And it's only going forward on favorable base effects and easy food prices that inflation starts to soften. And that is where we think that there is room for the RBI to do more. So to recap, I think that the government will need to do more and the RBI has the room to do more. And we need both fiscal and monetary policy stimulus for this immediate revival of the economy and to put us on a road to recovery. Because right now where we are is not exactly a road to recovery. It is a patchy and protracted unlock. It is protracted because there are still cities which are going into localized lockdowns. There are countries outside of us which are going into major nationwide lockdowns, which has serious implications on our export-import policies. And protracted because of this, and patchy because not all our labor is back. Not everybody is at 80% capacity utilization, and they don't even know by when do they need to be at 85% capacity utilization, and do they want to call all their labor back to ensure that there's capacities, that the factories are running at 100% levels or even 85% levels, which is where your potential gets met. It is here that I want to try and put a bright side to it. I also said that since this is not a financial crisis or an asset-based crisis, but a healthcare crisis, for an economy like India, which is at the cusp of reaping the demographic dividend, I think all our structural factors to make India the third largest economy over the next 10 years are very much in place. So our base case is that India will become a 5 trillion economy, but it will just not be by 2024, but probably over the 8 to 10 years. So my potential growth rate hasn't come off because of COVID. Just the time that I'll take to reach the potential growth rate from an economy perspective has lengthened. Whether it is my demographic dividend, the financial maturity of our markets, the financial inclusion, penetration of banking system, all of this has gotten delayed and probably protracted. But I would still argue that we will see the $5 trillion for India number. And it'll probably take us 8 to 10 years to reach there, but we should be there. And it's not something out of the books entirely. Lastly is what are the uncertainties that we are working with? Just a small anecdote, the use of the word unprecedented in these times has been unprecedented. So I think that sums up how uncertain and unprecedented this situation is. The biggest question on everyone's mind is, will there be a vaccine in 2021? Probably indigenous companies like Bharat Biotech are committing to a second quarter release of the same. What will the world recovery look like? Will it be a U, V, W, or L? Well, that depends on the vaccine, because if we do have a vaccine somewhere over the next 6 to 9 months, it should be a V-shaped recovery, and that's what we are hoping for, fingers crossed. But if that's nowhere to be seen, and what happened with the trials of the other frontrunners in this race, unfortunately happens with Covaxin as well, then probably the upward trajectory of the V will have to wait, and the lower trajectory of the U will probably get lengthened further. So just to summarize, I think there is need for the fiscal to do more. There is room for the monetary to do more. And we are nowhere close to, in my understanding, the pre-COVID levels. We have done surprisingly better than what pessimists like myself thought we will be. But I think that we need more support from both the ends, and we do have the room to do it. Just will like to touch upon, and I would like to take this opportunity, because I was the last speaker, and now that I've heard all the other speakers on the panel, that the reason the government can still borrow more apart from the 15 trillion rupees that they have asked is because the RBI can do a private placement of government securities and borrowings with the government. So our FRBM Act, which mandates us to keep the 3.5% of GDP fiscal deficit, there is a clause in that act that allows the RBI to directly buy government securities from the government if the GDP in a particular quarter is 300 basis points lower than the average of the last 4 quarters, given that June quarter GDP was a staggering 23.9% low. That condition has been met, and which is why the RBI can easily invoke this clause. So I think that the government won't find a big problem in terms of raising funds, because that is the need for the hour, and the RBI is by and large ready to service it also by law. And on the point on GST collections, because I have been clarifying this to a lot of my clients since morning. So the October number of 1,05,000 crores is 10% up. Himanshu, Nitin will really like the number. But again, the year-to-date GST collections are still 20% lower. And because there are still companies which are filing the GST returns of their previous months, let's just hold back our horses a bit to call it victory yet. We are on that path. We are moving steadily, but I think we need more support to be on, to be cemented on that path of recovery and come out of this patchy, protracted, bumpy revival. I'll stop here. Thank you.
Thank you, Asta. It's a really beautiful presentation. It was a mix of facts, figures, fiscal policy, monetary policy. Okay. So, I should congratulate you for a very beautiful presentation. Okay. And our students must be enlightened. All our distinguished speakers. Okay. So now we will, with no loss of time, we will open the session for interaction, for Q&A. Okay. So Alankrita, so can you please coordinate for taking with Q&A session?
Yes, sir. Now we are open for questions from the attendees, and Sagar will ask the questions on their behalf.
Yes, hello ma'am. The first question, we kind of did miss this topic, and I personally feel this question should go to Asta ma'am. It is from Arundhati Paul, and the question is, what will be the impact of deterioration in relationship between global powers as US, China, India, etc. on the economic recovery? And also adding one more layer to the question, that if you see the post World War II, whatever growth that largest companies have achieved has been export-led growth. China, Japan, example. If the international relation deteriorates, will it really impact our growth story?
So thank you for the question. I actually have a question for you, and if you can give me that answer, I'll be happy to answer this. Do you know who will win the US elections? And once you have that answer for me, I'll probably be able to tell you what form and shape the US-China relations and therefore the India-US-China relations will take. But as I said, as economists, our job is to identify what happens and you do scenario analysis. So I think the world as a whole is very keen on shifting supply chains out of China, either to their own economies and most importantly within the US. The trade war was fought on this premise, and whatever intermittent treaties were done between China and US, some of them may see the light of day if Trump comes back, and some of them may actually be discarded, depends on whether it's a blue wave or not. But the way things are currently, India's growth story is extremely skewed towards domestic demand. As Rajni ma'am also said, it's very little to do with exports. While it is high time that we identify our competitive advantage and move from low value add export items to high value add export items. But will it move the needle much for our economic recovery immediately? I have my doubts on that. For the other Southeast Asian economies, particularly places like Vietnam and Bangladesh, the US-China trade war has actually resulted in significant opportunities. And there is an immediate shift of supply chains away from China to Vietnam or to Bangladesh or even to their home countries in France and Germany. And I think that process will remain steady irrespective of who comes back to power. Whether it's a blue wave, whether it's a divided house, whether it's a re-election of Mr. Trump, the supply chain shift out of China will continue. Where will it go to? Will probably have some impact from who gets elected, because what kind of tax incentives and structures does the new president allow in the US will have an important bearing on whether they shift back to their own countries or shift back to other cost competitive economies. Second was the point on growth rate after World War II, which was export led for China and Japan. As I said, I think in India, unless so what we did in India, we actually jumped from agriculture to tertiary. We never really developed a manufacturing sector, and which is also what Rajni referred to, that and unless that focus or refocus or a missed focus on manufacturing comes back into play, for us to become a major exporting hub and for exports to become a dominant part of our GDP composition is still some time away. And it has little to do with geopolitical pressures right now and more to do with the policies that we have around land and labor, particularly in India, that resets the focus on manufacturing and makes exports a bigger part of our total GDP composition. I hope that somewhat answers your question.
Definitely, ma'am. My next question is from Harish E, and this question will go to yes, Miss. Sorry, yes. This question I'll ask Himanshu sir, and it says, "What's your take on the potential change in consumer behavior going forward? Will e-commerce industry take over the mall industry?"
I think Nitin might just be a better answer to that any day. But I'll just give a 2-minute answer, a quick one, and I think I'll let Nitin answer in much more depth. From my perspective, as I said, I don't really see a humongous shift away from physical movement. This may be a temporary measure considering where we are today, but we are effectively, we want to meet people, we want to go out, we want to, I think just a simple answer to this is, if everyone who's here on this panel today thinks that it is safe to go out, there is very little risk of getting COVID, can you answer this question? And most probably the answer would be yes, what we were doing pre-COVID. So it's a health crisis. Once the health crisis is mitigated, hopefully we go back. Anyways, we were seeing malls and e-commerce website coexist. Both have their own target markets, both have their own basis to work at. And I think it doesn't really, one has to cannibalize the other. India has a much bigger market than that. I think I'll let Nitin answer for this question now.
Nitin sir, can you take forward the question?
Yeah, so this is a question which has been posed to us regularly from last 4 or 5 years, I would say, and as rightly put up by Himanshu, that the total market in India, when you talk about organized market, is only 9%, and mall comes under the organized mall segment, and so there is a huge scope for that development coming in next 4 to 5 years. So that's more around how unorganized can slowly shape into organized segment, and how this is getting done, because government themselves are putting enough regulations in the system that you should be GST registered, you should have e-challan, etc. And slowly this segment is getting converted from unorganized to organized. There's a huge gap around that. I think coming back to your question on the e-commerce part, as again Himanshu rightly said, the moment you have a safe environment, the moment you feel safe today we are all scared. Let's accept the fact. We are all scared. We are all scared for ourselves, our families. And the moment we have a safe environment, which has been provided was, of course, more than 7% of our cost is actually getting into sanitization of malls, sanitization of toilets. There's a huge social distancing we have been putting in our system. There is a touchless parking we have started. We have started touchless food court ordering. You sit on the table and you order. So it's just an omni channel which we are providing inside the mall. So it's a combination of automated e-commerce versus meeting at a brick and mortar store. So from that perspective, slowly and slowly the malls are coming into are utilizing the digital benefits of getting automated as soon as possible. So that part is slowly and slowly getting taken care of. The third or the final part is when we talk about e-commerce. Slowly and slowly, if you see the difference between American e-commerce versus an Indian e-commerce, today the e-commerce is more around value buying. You get cheap product, you get higher discounts. That's what slowly and slowly online has become. The moment you talk, there was a time when one brand, same product, was getting sold at two different rates. People used to come to mall, they will take a QR code, they will find out the same product online, and they will go and buy online. I think over the period of time, brands have also realized that, and what they have started doing is probably as a consumer, you all should understand that as well. They have differentiated products also. So for online, they are preparing different products. So manufacturing itself is getting bifurcated into two parts. So from a product perspective, after a while, you realize that whatever you are buying from online versus, while you visit mall and you get the product, there's a stark difference between the two. I think over the period of time, consumers are getting literate on that. And I personally feel that currently we don't have any, scare in terms of, e-commerce taking over the brick and mortar stores. I hope that answers the question.
Yes. Nitin sir, if we could expand this on, we have another question, and it says, with limited footfall in shopping malls, do you think malls would adopt a process of delivering product to consumer and become a de facto distribution center within a city, something like that?
So actually we started that. I remember June, in the month of June, there were nobody in the mall, and some of the centers like Baroda and Bangalore, we started malls in the month of June, and we were actually getting only 10% of the footfall. So we said, okay, fine. If they can't come to us, why can't we go to them? So we started malls on wheels, and we started talking to the societies and going and reaching them. Some of the brands really started selling. So the brands which were selling high were, wellness, lifestyle. People started buying shoes, running shoes, Adidas, Puma, all those brands were selling very high. This was the time when you had, few festivities also coming in between. So, a lot of traditional stuff was also getting bought over there. But, essentially, malls are not only places, again, I reiterate that malls are not places only for, buying the product. I think it's a much bigger connect. Once you go to malls, now you go out, you spend time with friends, families, you go to cafe, you enjoy your shopping, and you feel the environment is cozy. And multiplex are going to open next month, so probably you go to multiplex, enjoy the food court, have different varieties, and come back. I think it's a complete experience journey while you go to mall today.
Thank you so much, sir. Now, next question is for Rajni ma'am, and the question is from Hari Krishnan. India supposed to recover in 2021, while Bangladesh managed a faster recovery, even overtaking India's GDP. What could we learn from our neighbors? And to add a layer to this question again, India has been an economy which has been metaphorically said as an elephant, and we have been missing the race all the time. First from China, Japan, then Asian tigers, China, etc. Now, do you think, Ranjini ma'am, that we'll be again missing the bus? And if yes, because we have a demographic dividend right now, will this lead to an inequality and maybe a challenge for stability for the country that we have not seen yet?
So first of all, Bangladesh has taken us over in the per capita GDP figure, not GDP, a very important one that would kind of take us way below. Yes, to an extent, you're correct that, if you notice since 1980s, I would say every 5 years, India has had a very high potential market and everybody is focused. And then suddenly we don't match our potential and we kind of, stay short of what was expected as an economy. Having said that, do remember how the global economy works. And, this, I would weave in the China-US geopolitical part here as well. By all measures, China is expected to take over the US GDP size by 2025. And now with this COVID hit to growth, it would probably be earlier by 2023. So everything on the geopolitical, financial flows, on the trade side stays as a news. For around 20-25 years, we've had a US-centric global economy, and now the center is changing towards China. So that's something that stays. Why has India fallen short in the current way? India never was very keen on the export-oriented story, which is where we fall short of any Bangladesh comparison, no other matrix otherwise. We never had the aspirations, we never really wanted to, and we never really have won on an export-oriented race. Primarily, A, it's not a big part of the overall GDP. B, we till recently didn't have an economic focused trade relationship. It's only recently that we've talked about economic diplomacy. C, there's always been a delayed reaction to understand where is the economic axis moving. For example, if we are now an economic focused diplomacy, we would probably be tilting towards China, then away from China and making all the US aligned noise about China. Bangladesh has been able to, because it's the small economy, it has been able to identify that, its key remains in exports, in jute, in high labor intensive sectors, and it is just focused on that sector. So there could be many metrics where you compare and India would kind of fare much better. We are not interested in that kind of a labor condition, in that kind of a very export-focused sweatshops, as they call it. And if there are many firms in Europe that have regulation, they don't go and shop around in Bangladesh for their supply chain. So those are the things where we fare much better. It's a democratic economy. A, B, Ruchir Sharma has done a book where he's kind of explained very well in terms of how the elections remain socialist. So while we essentially aspire to be a capitalist economy and to kind of, have certain growth rate and do certain sectors and grow like US, our elections are won over socialist causes. So come election, we kind of leave aside all of those theories and kind of get back to the populist moves. So which is where we are losing, essentially, not matching what our potential is. Having said that, we remain the second fastest, largest growing economy in the world, post-COVID, of course. So that's something that keeps the focus essentially on, in terms of financial flows, in terms of investors, in terms of anybody looking at consumption story, large market, US, Europe, Japan has largely been saturated. It's China and next India. So if you were a hedge fund sitting in London, or if you are an investor sitting in New York, the two markets you would think of it, China, what next? India. Yes, India versus South Africa versus Malaysia versus Philippines, a few countries where we are competing in terms of EM flows, in terms of their investment plans, but we remain one of the big ones here and one of the fastest growing ones. So in year when we kind of overtook China, we were actually the focus of the global economy. So short of potential, maybe our inbuilt optimism where we feel that there's so much we can potentially do and then we fall short of it. But we've done fairly well, an average 7.5-8% growth rate over almost a decade now is a good record to have. So that's something I, really wouldn't debate about. Yes, lots of issues on the policy support side and hence falling short of expectation. Given that we are a democratic country, given that we still have a socialist thread, that will remain, that will stay. Pretty much like how global geopolitical, the world is jaded with globalization narrative that didn't work for them. It's not only Trump happened, Brexit happened, there's so many events globally happened. So there is a jadedness everywhere in terms of capitalist story. That's something that's kind of keeping us away from what we could essentially do if we were a very market-oriented economy, which we are not. And hence short there. But otherwise, every which way is better than Bangladesh. I wouldn't really be happy to take that comparison. per capita income in a year when our incomes have degrown, I think it's a ridiculous comparison. But for headlines,
Thank you so
much.
Thank you so much, ma'am. In the interest of time, I'll hand over the floor to Alankrita. Yes.
Yes, I'm grateful and thankful to panelists for their valuable insights. To summarize the session, I understand the challenges faced by Nitin sir, the importance of optimism from Himanshu sir, big picture of post-COVID policy changes from Rajni ma'am, and numbers around actual objective and impact of lockdown and consecutive unlocks on Indian economy from Astha ma'am. While the fate of the economy is under clouds, the efforts behind organizing this event are not. I would like to thank all the panel members for their precious time. The session would not have been possible without the support of Professor Khanna sir and the Avartan team. Last but not the least, I would like to delineate the efforts of members of Team Street, the Finance Forum of NITIE. Once more, thank you all for your precious time. I now request all the panelists to turn the camera on to have a photograph of the event.
Give me a second. I'll just check with others. Yes. Go ahead. We have almost everyone. Yes.
Thank you. Thank you so much, panelists, once again.
Thank you.
Thank you.